Is this the golden age of private credit in your mind? Right now, you work with a lot of middle market companies. What are you seeing when it comes to the landscape, and what's your outlook for the back half of the year?
Yeah, I think it's a great question because what we're really seeing actually is an evolving private credit market. And so, in the comments that you made, and even the kind of firms that you're referring to, they tend to focus on what we would know as the upper end of the private credit market. And so, the private credit market is not a monolith. We're talking about private companies that maybe begin with 5 million in revenue all the way up to a billion in revenue. So you can appreciate there is a wide variety in those firms. For example, rather, as you refer to at the Copia Group, we're focused on direct lending to private companies in that lower echelon of companies, so the $5 to $150 million range. And again, what we see there in terms of not only the return characteristics in that part of the market, but also even the type of companies that we invest in and with and their behavior, it's quite different.
All right. You gave us a forecast. I would imagine you probably got this forecast from Preqin or somebody like that. But right now, the private credit market's 1.7 trillion. You see it going up to 2.8 trillion in 2028. What's the catalyst? Where are you getting this visibility from? I mean, it seems like the growth of private credit has been largely due to tightening of lending by big institutional lenders and also an increase in interest rates. So do you feel like interest rates stay elevated over that time? I mean, what's the reason that you think we get to that 2.8 trillion?
So there are a variety of things that are driving the growth in the private credit market that I actually think from a secular standpoint will continue. So first of all, really over the last decade plus, what we've seen is the structural shift in lending, moving away from what we would call traditional banks like money center banks and regional banks into the private market, some of the firms even that you refer to. And that shift has largely taken place. But what's happened is the overall amount of commercial credit we're seeing over that period of time hasn't changed much. Now, if you flip to the demand side, while you've seen institutions moving into private credit, on the larger side, you're seeing smaller and mid-sized institutions. And we're on the earlier phase of the shift that I think you'll continue to see in high net worth investors or private investors. So think about demand structurally fueled by not only the kind of clients that are coming in, but the quantum of that. The very last thing I would mention in terms of what will fuel that continued growth isn't it that evolving I talked about in the type of strategies. So again, much of what we've seen in private credit is what we would call senior-backed lending. So think about large companies, even public companies like Meta, tapping the market. Again, you refer to that. But now as we see specialty finance and as we see growth in other asset classes, as we see growth in specialized strategies like we're pursuing, again, you're going to see other types of borrowers accessing the market and tapping into that secular demand that I tell you about.
All right. I want to come to what may be a pressing question for a lot of our audience. What about private credit when it comes to retail investors, accredited investors? What's your point of view? So last week, BlackRock came out with a white paper saying they're going to launch some target funds for 401ks, where private credit would be like 5, potentially 20% of that fund, or to kind of get into a 401k. You come from the equity space. You're former CEO and president of Northern Trust. What's your view on private credit when it comes to accredited investors, retail investors, and also retirement accounts?
Yeah, I think this is a very important question because we're always taking risk, and you want to make sure as an investor you're getting compensated for the risk you take. The short answer I would say is this. To the extent investors are working with very competent investment advisors, and they're tapping into that expertise in the way that they access those strategies, private credit can have a role in the portfolio. But again, we're talking about a more relatively illiquid investment. We're not talking about investments like in the public market where you have ready access to lots of information. So I do get concerned when I hear more and more about quote unquote retail type strategies where they're not even tapping into what we would know as the illiquidity premium that exists in private credit. And so what I would say to you at the end of the day is all credit is not created equal. Mm-hmm. And certainly we have to be very mindful when we say more retail dollars are coming into private credit if we're not doing that in a prudent way with strong underwriting and good advisors.
What about the success of some of these funds? I mean, do you see them actually being successful? Because one of the issues with them are the high fees. I was actually talking to Vanguard last week about ETFs, but there's some similarities. They gave me this stat that really blew my mind. Only about 2% of ETFs have an expense ratio of 3 basis points or less, and about 28% of the flows go into those. So it seems like retail investors, especially more educated, accredited ones, they want lower costs.
Well, I think what you're seeing, and again, I know the ETF market well, many strategies are quote unquote more commoditized. And what we mean by that is they're tapping into the parts of the market that don't offer a lot of diversification, a lot of variability, a lot of potential for risk premium. Now, broadly speaking, private credit can offer more of a range for that. But I think you will see a divergence in the market over time where you will see pricing come down on a relative basis for more commoditized strategy. In an efficient market, like what should happen, you'll see when you can truly capture alpha or excess return, those type of strategies will command, in a sense, the higher expense ratios or the higher costs.